My name is Morten Gustavsen. I work as an equity trader in DNB. I also work as a data scientist, and that's the part of the work that I will show you today. Now, the question that I will try to answer in this presentation is actually, what is a good trade? Now, it's quite an easy question to ask, but it's actually quite difficult to give a good answer to that. Say, for example, if we are going to buy 300,000 shares of Ericsson shares, that would be a sort of a typical trade for us. And say that if the shares are trading at around 60 kroner when we start to do the trade, and we end up buying the shares at 60.1, would that have been a good trade for us or not? Well, that sort of depends. Now, how many trades or how many shares are actually traded in Ericsson on a typical day? It turns out that it's around 15 million shares that is traded in that name. So our trade would have been about 2% of the total daily volume. So this trade would be at sort of 2% ADV. Now, our trade at 60.1, when the trade started at 60, that would be a 0.17 price increase. So we had a 0.17 price impact on a 2% order. That is an order that was 2% of the daily volume. Well, is that a good trade? Well, perhaps. It's not bad, but it really depends on one more thing. It depends on how much time did we spend on this trade. Now say that we spent around 1 hour to complete this trade. Then this trade would be quite okay. It would actually be slightly better than the average. Because in finance, it's always this trade-off between risk and reward. And when it comes to equity trading, this trade-off is between the amount of price impact that you will have in the market and the amount of time that you're willing to spend buying these shares. The longer time you're willing to spend, the less price impact you can expect to have. But also, there's much longer time going on, so a lot of things can happen. There will be a higher risk for perhaps some bad news coming in the market. Now, the challenge that we have here, first of all, it's a quite noisy data set. The typical sort of a price impact that we're looking for is in the range of 0.1 to 0.2%. And a lot of the data that we have quite large outliers that I will show you. They are often in the range of 10 to even 20 times our signal. So how we handle all of these outliers is actually a key to get some sort of sense out of the data that we have. And even if there is this risk and reward always in finance, there is really a good and a bad way of doing this. We are using a lot of trading algorithms, and it appears that some of these algorithms have a better trade-off than others. And what I'm going to show you today is how we went about to find out which trading algorithms have a better trade-off than the other ones. And these trading algorithms, we don't make them ourselves. We use the brokers' trading algorithms. So for us, they are really a black box. We get some glossy PDFs that tell something about what they are doing, but they are not telling us the true story about what happens with these algorithms. So we can only use the data that we get afterwards to figure out if the algorithms are as good as the brokers claim them to be. Now, what typically happens when we send a trade to an algorithm, say our Ericsson trade of 300,000 shares, that the trade is typically split up into very small pieces, and each piece is usually around 100 to 1,000 shares. And then the algorithm is sending each little piece out to quite a high number of trading venues. And each trading venue is like a stock exchange. You all probably know about the Stockholm Stock Exchange, the Oslo Stock Exchange, etc. And that is certainly a part of it, but it's only a small part of it. There are also a lot of other electronic exchanges, and we group them into the traditional exchanges, the ones I just told you about. And we have what we call lit trading pools, and we have dark trading pools, and we also have the broker-operated trading pools. I don't have time now to go into what each of those are, but it's quite important for this presentation to understand that how the algorithm behaves have to be quite different in each of these trading pools. The algorithms have to use the right tactics. And actually, for the algorithm to have the right tactics is one of the ways that the algorithms can differentiate themselves. Because you probably can't see it here, but I try to make a small shark down in the corner. And out in the market, there are a lot of hedge funds. And one of the strategies that they are using is to try to find out when people like me, the big institutional buyers, are buying big blocks of shares. And they do this by analyzing the trading flow at the various venues. So how these algorithms are able to disguise themselves, perhaps randomize the trades, etc., that's quite important for not getting detected. Another important thing for the algorithms are the screening, because not all of these venues are as good as the other ones. Some have more of these hedge funds. So if the algorithms are able to screen those out and don't use them, we typically end up with a better trade. And then it's the access. Not all algorithms have access to all the trading pools. And that's especially true for the broker-operated ones. And this was really one of the first insights we had when we started to analyze all our data, is that not all the brokers are willing to trade with all the other brokers. If you look at this one, you can perhaps see that the broker called Bernstein, they are really trading with most of the other ones. But some of the big ones, like Goldman Sachs, Morgan Stanley, etc., they are not really willing to trade with the other ones. They are very happy with their own trading pool. And the way we use this information is that this enables us to perhaps use more than one algorithm at once. Say we can use 1 or 2 or 3 running in parallel. And when we know how the algorithm behaves, which venues it's using and which venue it's not using, we're able to have a much more efficient coverage of the market. Now, the other insight that we had was when we took all our trades. This is a scatter plot on the left there of all our trades in Europe that has a less than 2% ADV. That is a share of the market. And if we plot that with this ADV number on the x-axis and the price impact it has on the y-axis, and by the way, the price impact is flipped so that for buy and sell, the negative impact is always bad, and you can also be lucky to have a positive impact if there are some other news in the market. But if you look at this cloud here, it's not really apparent that there is any structure there. So what we did was that we sorted all the trades by their ADV number, and then we grouped them into groups of 100, and then we actually just removed the best and the worst 10%. And the thinking behind that is these big outliers here. They are probably not due to our trading in the market. It's much more likely that there are some news or some other big players out there that are driving the price up. And just by removing that, and then for each of the groups, taking the average ADV and the average price impact, and then plotting those results on a new scatter plot that we are here, there's a much nicer trend. And it's much more apparent that there is some sort of even linear relationship here between the ADV number, that is how large our order are compared to the total amount traded, and the amount of trade impact we have. And actually, if we just plot a small regression line, we can see that the slope of this line is about minus 0.1. And that means that for each percent ADV that we are in the market, we can expect to have a 0.1 price impact. So going back to our trade with Ericsson, in that trade we had a 2% ADV, and we had 0.17 price impact, which is actually slightly better than the 0.2% that this regression line should suggest. Yeah, and as I said, in trading, there is always the price impact and it's the time. So we can do the same exercise for time. We just use the same groups that we had for the impact regression with the same orders removed. And if we now take the average ADV and average time it took to complete the trade for each group, we can see that we get a very nice regression line, and it's even tighter than the regression line we have for the price impact. And also from before, you can see that there is really hard to see any structure in the data before we do this grouping and trimmed mean. And here you can see that the slope is about 36.7. So this means that for each percent that our trade is of the total daily volume, we can expect the trade to take about 36.7 minutes. And again, for our Ericsson trade, that was a 2% ADV trade, and we completed it in 1 hour. So that's also slightly better. Now, this is the trades that we have for all, or this is the regression line we get for all our European trades. But of course, what's interesting for us is how each separate algorithm is comparing. So we can do the same process, but for each algorithm instead of for all the data. And that's what we did. And if we now plot the slope of each algorithm, the slope for the price impact and the slope for the expected time it should take, and plot that on a new scatter plot, then we really can have the answer to the question we started with: what is a good trade? Because you really want to be up in this corner here. Up here you have no price impact and it takes virtually no time to complete the trade. But that doesn't really happen. We can recognize this dot here of all the European trades. We can see that it has a slope of about -0.1, and for the time it's about 36 minutes. But then we can also see that there are some algorithms up here, the TAP algorithm, for instance, that's quite better, both in impact and time. And that was a surprise for us. We had some feeling that this algorithm was good, but not that it was this good. Also, you can see that there are some that are really not performing at all. So the way we use this information, and also the information we have about which brokers are trading with each other, that was made it possible for us to go from an average impact in the market for all our trades from 0.15 to 0.10. So that's actually a 33% improvement. And even if this is small numbers, we are trading, at least last year, at about $21 billion. So even these small percentages is quite significant value for our customers. Thank you.